Risk in complacency. Debt-laden economy. Prior to the COVID-19 pandemic, the United States was enjoying a relatively stable economic period, often described as a Goldilocks economy, where conditions were neither too hot nor too cold. However, even during this time, certain economic vulnerabilities existed that could not be overlooked, which later exacerbated or complicated the situation amidst the COVID-19 economic upheaval. One notable concern was the size of the U.S. national debt. By the end of 2019, the U.S. national debt had escalated to 107% of the country's GDP. This was a significant increase from the stable levels of less than 65% maintained until 2010. The sharp rise in debt was primarily attributed to the efforts to recover from the 2008 global financial crisis. It is essential to note that a high national debt ratio does not inherently indicate an economy in peril. There is no universally agreed upon, safe, level of debt. For instance, Japan's national debt ratio was over 200% in 2019. Similarly, nations impacted by the European fiscal crisis demonstrated high debt ratios, such as Greece at 181%, Italy at 135%, and Portugal at 123%. The critical aspect of national debt is assessing the government's long-term financial capacity to manage and service its debt. By the end of 2019, the U.S. had set its target interest rate quite low, between 1.50 to 1.75%, and its GDP growth rate for that year was recorded at 2.3%. This implies that the growth in government revenue, proportional to the economic growth, was surpassing the interest rate levels, indicating a sustainable capability to manage interest and principal payments over time. Therefore, despite the high debt ratio, the market did not overwhelmingly perceive the U.S. government's debt level as an immediate risk. Nevertheless, a more significant concern was the level of corporate debt, which had reached historically high levels, propelled by the prevailing low interest rates. After a brief decline during the resolution of the 2008 crisis, corporate debt began to climb steadily around 2011 and 2012, eventually reaching 75% of GDP by 2019. This surge in corporate indebtedness was recognized as a considerable risk, especially considering how it could affect the business sector's resilience in times of economic downturns. Overvalued asset market. Amidst a climate of low interest rates, companies capitalized on the opportunity to amass considerable amounts of cash through debt instruments, which in turn injected substantial liquidity into the market. This influx of capital contributed to the elevation of financial asset prices. A specific concern that emerged prominently was the inflated valuation of the stock market. Following a gradual recovery from the 2008 global financial crisis, the stock market began a robust upward trajectory starting in early 2016. The issue with these inflated asset markets is their potential to amplify the effects of market corrections or increase the market's vulnerability to economic shocks. When asset prices are excessively high, they are prone to a sharp and profound decline in the event of an economic downturn, leading to a more dramatic and detrimental bubble burst effect. While at the time, the general market sentiment did not heavily lean towards the view that high stock indices were unsustainable or posed grave risks, several experts and members of the Federal Reserve expressed concerns about the overvaluation of assets. They cautioned against the potential for a bubble economy, making it challenging for the Federal Reserve to justify further reductions in interest rates. Lowering interest rates in an already inflated asset market might exacerbate the situation by driving asset prices even higher. Conversely, maintaining a higher interest rate would provide the Federal Reserve with a buffer, allowing for more substantial rate cuts in response to future economic downturns. Despite these concerns, the trend of stock overvaluation persisted, culminating in record highs for major indices. The Dow Jones Industrial Average soared to an unprecedented 29,551 points on February 12, 2020, and the S&P 500 index reached its peak at 3,386 points on February 19, 2020, reflecting the heightened market valuations of the period.